Good morning or good afternoon, depending on what part of the world you're in, and welcome to the second of Captive Review's virtual symposium. I'm Lauren Ingram. I'm the editor of Captive Review. So we're running a series of these, and we're in partnership with Ekiroa for today's symposium. So welcome if this is the first of your virtual symposiums, and welcome back if you've come back. The topic for today is the global hardening market, something that's been on everyone's lips for the last year. So first, some housekeeping. As our virtual symposiums are interactive, you have the opportunity to submit questions to our panelists. To do this, you just need to go to the website slido.com and enter the code CaptiveVirtual when prompted. That way you'll be able to enter questions that our panelists can answer during the Q&A sessions. Now, to quickly go through our agenda for today, we're going to have a quick welcome from myself and my co-host, the chairman of Ekiroa, Udo Capes. We'll have our first panel today on exploring the global hardening market and opportunities for captives. Then a short break and a discussion with Udo and I before our second panel, managing your captive in a hardening market. We'll finish up each panel with a Q&A, so make sure you get on slido.com and submit your questions during the panel. Now, I'm very pleased to introduce Udo to have a talk about Ekiroa.
Well, thank you, Lauren. First of all, if you hear me coughing, don't be worried. It's just a regular cold. A warm welcome from my side on behalf of Ekiroa. My name is Udo Capes. And as Lauren said, I'm the chairman of the board of Ekiroa, the European Captive Insurance and Reinsurance Owners Association. Our members are companies owning captives in Europe. And the objective of the organization is to protect and support captives in Europe, as well as to defend their interests in front of regulatory bodies. The main topics which keeps us busy in this respect are dedicated efforts to explain the specifics of captives towards, for example, EIOPA, the supervisory body of the European insurance regulators, in order to achieve more adequate rules regarding the application of Solvency II, specifically exemptions from Solvency II for small captives, less reporting burden for captives remaining under Solvency II, and a consistent application of Solvency II rules by all national regulators. Another important task of Ekiroa was and still is to defend the interests of the captive owners in respect of the OECD and its conclusions with respect to base erosion and profit shifting, so-called BEPS. Ekiroa also is a forum for captive owners to exchange experience. The most important forum organized by Ekiroa in cooperation with Sika and Pagan Media is the Biannual European Captive Forum in Luxembourg. This year, the forum is still expected to take place on November 4th and 5th. However, we are carefully reviewing the coronavirus development and its implications on events like the European Captive Forum. Ekiroa is happy to support today's symposium on the global hardening market, as it is good timing to exchange on this topic and which role captives can play in this situation. As many risk managers already increased their shares of their captives to cope at least partially with the hardening market at the end of last year, it is now the time to prepare for the 2021 renewal. This is even more important as it can be expected that the hard market will not become soft in a short time period. The contrary might be the case. I'm curious to listen to and learn from the following discussions and hand over to Lauren again.
Thank you so much. So now we're going to introduce our first panel. We're very lucky to have a number of experts with us today. First, we have Nigel Goodlad, Regional Managing Director, the Global Captive Practice at Willis Towers Watson. We've got Carl Lehman, Chief Risk Officer at KTN. We've got Julie Bordeaux, President and General Manager of PCH Mutual Insurance Co. RRG. So now I will hand over to Nigel, who's going to moderate and speak on the panel.
Hi, thank you very much. Welcome everybody. This is Nigel Goodlad speaking of Willis Towers Watson. I represent the captive management insurance company management arm of our business operating within Northern Europe. The offices are my responsibility. It's a pleasure to have on the panel with me Carl and Julie, who both are captive owner organizations, and these questions were posed with the topic exploring the global hardening market and its opportunities for captives is quite topical right now. So given the fact we've just got 30 minutes for this session, I propose to dive straight in and pose the first question. Maybe Carl, could you provide a take on the events leading us to the potential current hard market, and how, your business specifically, how have you had to combat that news? Shall I put it like
that? Good afternoon, Carl Lehman speaking. Yes, thank you. Well, I think everybody knows about the hardening market. And just for the sake of clarity, Katunasi is not an organization of captive owners. It's we are a logistics company and we have a captive. So we've been confronted with the hard market, not too much, I would say, right now, because I think the hardening market is very dependent from one type of business to another, and also geographically speaking, there is a quite some difference between the increases we've seen in coverages, well, in rates, I would say, increases in rates, and the limitations in coverage that we see all around. But generally speaking, yes, it is a hardening market, and the whole corona situation will certainly not make things easier, because we're going to see that a lot of companies may get into financial problems. Premiums could not be paid because of eventual bankruptcies and stuff like that, or lower volumes of premium in employee benefit programs, more claims. So it's could be quite messy, I think, and I think nobody foresaw what's happening now. And I think the hard market we've seen so far could be kind of a kindergarten compared to the mess we're going to see once the results of the whole corona circus will become clear for everybody. Having said that, most of our programs are on a 3-yearly basis. So we've just a couple of them coming up for renewal. The rest has been renewed a while ago, so we don't have that yearly problem. But my point is that I think everybody's now talking about the hardening market, adapting premiums, adapting coverage, looking for other solutions, but nobody is actually working on the cause of the hardening market. And that's my main point. I think we should work on the cause of the hardening market. And if you look at some figures, it's quite stunning to see that the bulk of the damages and the bad results that we've seen with insurers are for a not so small, even to say a very large chunk, based on the natural catastrophes and on liabilities. And both those natural catastrophes and those liabilities that we see are so much bigger in the whole US continent than they are in the rest of the world. And I think it's not an easy one, but that we should try to lobby, and it will take time, to eventually have changes in the US legal system, or in the ways that the law firms operate in the US, because the damages that you see and the verdicts that you see are going, again, way out of control. We are,
Carl, do you see this for your perspective lasting a longer period of time than there's just a 1-year correction? Do you think it's here to stay for several years? And Julia, would you like to comment after Carl?
Yes, please.
On the duration, it's a bit difficult to say. I think it will certainly be longer than a year. Some of the corrections may have been done and were done, But again, I think when we had New Year and everybody thought, well, we've had the worst, nobody was aware of the consequences of Corona. So I think that's really a game changer in what's going to happen and make it even more difficult to predict what's going to happen.
Yeah, if I may, Nigel, this is Julie Bordeaux, and PCH Mutual is a group captive domiciled in Vermont. We have over 1,700 owners of personal care homes and assisted living facilities in 47 states in the US. So I can definitely speak to what Carl was talking about because the hardening market in the US and in our particular long-term care area certainly was precipitated by a number of insurers leaving the market. Also, the typical metrics with the falling investment returns that we're going to see now, and we have low interest rates here in the US in particular, that all of those things have come together to create this market that I do think definitely has will sustain, as Carl predicted. The other thing that Carl mentioned, and I agree with as well, is trying to address a cultural shift that we need in the United States with regard to our legal system. Because culturally, I would say, and I am just trying to be straight with everybody, I think we do have also a little bit of a cultural plague in the risk aversion, unrealistic expectations, and somewhat of a sense of exceptionalism that have conflated into something that has been very difficult for businesses to thrive. And as you know, risk retention groups were created so that small businesses could still thrive in our economy and afford to insure. So we are also a very price sensitive demographic. Our particular insureds, we don't insure large skilled care facilities or big chains and things of that nature. So in our response to the hardening market last year, I think the listeners may be curious to know what we did. So we did a rate study and considered how much we could raise rates and what that would do to our particular program. And we're delighted that it did not affect it. We saw significant growth despite the rates. We didn't raise to the top of the rate, possible rate hike, but it was a significant increase. For our program, and I think for captives in general, we are always balancing the value proposition with any sort of adverse thing like a price increase. We're always looking to demonstrate the value proposition. So in that case, increasing our risk management tools and publicizing that. We have a hotline for our insureds to reach out to a licensed attorney in their jurisdiction for free when they have a loss or a potential loss. Always capitalizing on what the captive industry is best at, which is, I apologize, to essentially always be considering our members in giving them value.
Carl, can I ask a question? Would you consider your business has had to change in the last 12 months, its risk retention and its way of its mixing its operating deductibles and central funding on its key risk lines? Or have you been insulated from the severe impact of some of these and you're expecting the tsunami wave of rate increases on certain lines to take effect in the tail end of this year or into next year?
Well, Carl speaking here. Yes, so far I could say that we have been a bit out of the tsunami. We haven't had those big, and now I'm speaking for my own company, we haven't had those big rate increases yet. So I will see my 3-year liability, global liability renewing is coming up now, January the 1st. So looking forward, and I'm already working on it to see what's going to happen there. But of course, we took a number of precautions, and we do our risk mitigation. A lot of invested in there. We don't walk from one insurer to another for the fronting. If we get slightly better conditions, so we stick to our, we try to stick and have long-term, really long-term agreements. On the increase of rates in the captive, I think we should be very careful there, because one of the reasons why you have a captive is to stay away of the increases and decreases that you see on the market, and to have a more stable rate profile in your pricing. So of course you have to follow more or less a little bit the trend, but I don't think we'll have we should have the peaks that you see sometimes in the market and in certain types of business. I don't think we should reflect those in a captive, because then we are taking away one of the reasons of being of a captive.
Yeah, and it sounds there's then, from a tactic point of view, your reliance on strong working relationships with certain key carriers is a way to navigate through this on a strategic approach. And Julia, I was interested to know, do you take that similar line with maybe any of your catastrophe reinsurance suppliers as well with a captive, if you use them in that way?
In terms of, I'm not clear on the question, Nigel. If you could rephrase that, I apologize.
Sorry, do you rely on long-term strategic partnerships with certain key carriers on key lines of risks for your RRG?
No, we have a strong partnership with our reinsurers, but we are professional liability and general liability, and we have strong partnerships in that regard. But we don't have some of the other unique risks that you might be referring to in that question. What I would say, though, Nigel, in talking about kind of the opportunities for captives in a hard market, is that we do have that agility, that ability to create programs and ensure risks that might not be as available in the commercial market. In last week's webinar, Courtney Claflin, I think, addressed this very well, and I know he's in the next panel with regard to what we can do. And so what we're trying to do to increase the value proposition for our insureds and make sure that they're fully protected is to consider coverages that cause them.
I mean, from a case in point with, hello?
Hello?
I've lost you.
I am still on the call. And hello?
Yeah, maybe I will take over if there's or if there's a technical problem to give some feedback on those coverages that I was referring to on that basic problem. If you see, I mean, in the US in 2017, 1.4 billion was paid out in hurricanes and wildfires. In 2018, that was 41 billion. So those are huge amounts and are way above what has been paid out in other parts of the world. Same with D&O. If you see, on average, the D&O claims in the US go above 65 million, while in other parts of the world, those on average go about around 3, 4, 5, 6 to 10 million. In trucking liabilities, we see now verdicts in the US of 260 million in one case for a simple car accident. So those things are really spinning out of control, and we really should lobby to get those things back under control again. Because even if you have a captive, and that's one of the things that is difficult in a captive, with what we saw with BEPS, is that you try to cover things which are not available on the market, which we all think. I think there should not be too much discussion. That's one of the reasons of being of a captive. But just exactly that one was questioned by BEPS, where they said, well, why would you cover something in a captive which was not covered on the market? So, I mean, it's a bit weird, but that's one of the things we are facing with the people with the OECD, and that's not an easy one to tackle. I don't know, Julie, if you can comment on that.
I don't know if you can hear me.
Yes, I can hear you.
Yeah, I think, sorry, Julia and Carl, I think we're having some technical difficulties, so please bear with us. I think I keep fading in and out. I think Julia does as well. So, I apologize for that for anybody listening in. I suppose there's a couple of points for me with the recent hard market. We have had, as managers of captives in the area, some recent examples. For example, somebody in heavy engineering who decided to set a captive up as there was virtually an increase on their property rates online by about 500%, and a compulsory deductible jumping from several hundred thousands to the millions. I mean, these things are game changers, and they do happen. We've had other experiences in professional insurance lines where design, construct, engineer firms have found their market risk transfer market not evaporate, but difficult to find, and they've slotted a captive into the risk solution mix. So it's pleasing for me as a provincial service provider to support captives that we are seeing in Europe some activity. But obviously in America, it's generally there's a lot more activity ticking over all year to year, and not just in hard market. But it is interesting to see a bit of a wake up. Do you want to comment, Carl, on where you see? We mentioned, I don't know whether you actually answered it. Did you think this is going to be the hard market a short-term jerk effect, or do you think it's genuinely here there's some major strategic correction and we're going to have to just live with it?
Well, as I said before, I think you have two things. The correction that we've seen last year, which was probably to continue, but on a lesser extent this year. But all that was not taking into account the effects of SARS, of COVID. Sorry. So we don't know, to be honest. I think that the effect could be big on the market. Companies not paying premiums. Losses. I mean, nobody knows today what's going to happen in the US, where you saw that they are trying to impose to insurers to have a retrofit cover of BI for all type of companies smaller than 100 employees. It is now, I think. They're set up a pool, but they will have to indemnify retroactively, and that could have a big impact on the market. I think we haven't seen and heard the last of that, but all those things together make it even a more unstable market, and another reason for insurers not to stay with or to handle their clients in a commercial way, because they don't know at all what's going to happen with all those changes, and again with the effect of COVID, which we haven't seen yet. So I think yes, the hard market is. I wasn't a very firm believer of a long-term stay of it, but with the COVID, to be honest, I don't know what the effect will have on the insurance market, and also I would like to see what the effect will be on on the captives, who for a number of them have been employee benefits in their coverage, and I don't think that anybody had foreseen a pandemic in the employee benefit coverages, or the effect of a pandemic on the employee benefit coverage. So I think that also will be interesting to see what effect that will have on captives.
I'd like to comment on what's going on in the United States, because obviously the business interruption is a major concern, and there are a number of states who are trying to legislate policy changes to provide coverage. Obviously, there's been a tremendous pushback on that. There's also just California insurers, and I'm sure insurers from other states have written to the federal government asking for a fund to be created similar to the 9/11 fund, so that business owners and people who are affected would have a federally funded option as opposed to going to their private insurers. On the other side of legislating in the COVID era, there are now, I think, at least 5 states, if not more, that have passed legislation and passed it to prevent professional liability claims against healthcare providers. For some of it is all of 2020. So anything related to COVID where a healthcare provider was brought in, you know, obviously it's all hands on deck. So there's retired folks, there's people in training, things of that nature. There are a number of states, and I think more states will follow on to prevent claims against folks. And so the professional liability exposure might not be what folks initially think, particularly in healthcare. Back to you, Nigel.
Hi. Yeah, from the COVID-19 then, I suppose we have to think it's a question of how maybe a captive could respond rather than it will respond. I think there's some risk evaluations to be done across many risk strands before we come to a conclusion on this. And I'm sure the jury will continue to review this, working with various service providers, from the actuarial personnel to the risk management personnel to broking personnel to captive managers and lawyers. It's obviously going to be a future minefield to navigate through. Is there any, from your point of view, Julie, any parting comments as we come to a close on our 30-minute slot and open it up for general questions you'd just like to get across? And likewise, Carl, if you could respond afterwards.
Sure. I would say that from catastrophe comes positive change. So we are always looking at what came through in this catastrophic situation that could create an opportunity perhaps to provide coverage similar to coverage that we have in our policy for evacuation, so that our insureds feel they have the money to evacuate, and that would avoid a more catastrophic claim. So looking in terms of those kind of coverages, and we have that kind of agility in our program that we can do. The second thing is, I've always believed that captives, and particularly in our case, group captives, harness the power of the collective. And there's nothing to bring into the cultural sensibility, the idea of we're all in it together, we are a collective, than a global pandemic. So I think that we can think through some positive changes here.
Well, thank you, Julie. Carl.
On the captive, I mean, I'm, if I may say so, lucky that I have a pecuniary losses policy that is insured by my captive, and where we do have a pandemic coverage. So I don't have the hassle of the discussion that some other people have on trying to get it under the BI. So it's I don't have a point of discussion. It's covered. Only the amounts will be a bit too low, but I mean, our captive is also quite young. So that will be one of our aims in the future, to increase the amounts covered, but the coverage as such is okay. Only the amount should be increased if in the longer term. But I mean, the whole COVID thing will, and yes, we are all in there together. But if you see, it's fascinating to see how, for example, in Europe and also in the US, all the states in the US that have different views on it, different ways of how to fight it. This is the same in Europe. Countries have closed their frontiers again, so people are talking about the Marshall Plan to start up the industry again after it. Only we shouldn't forget that the Marshall Plan after the Second World War was paid by the US, and I don't think that the US will be in well, we still have to see, but in a position that they will have a lot of funds to spend on other parts of the world. I think they will have enough problems cleaning up their internal issues. So it will be interesting and fascinating to see how we will continue our journey.
Okay.
But I think, as Julie
Thank you
said,
for that.
we're all in it together.
Excellent. Can I throw it open to the audience if you've got any key questions you would like us to address whilst we're on the line? I'm more than happy to do so. In terms of the technology, I believe you can type a question onto the panel, and we would share the question.
Yes, so Lauren back here. We've got some questions that have already come through while the panel's been speaking. So the first question that has come through is here for Carl. So it said, from Steve Tunstall in Singapore, Carl, do you think the current market 3-year deals will become a thing of the past?
Well, there is a difference between what you think, what you hope, and what is the reality. I hope not, because I'm convinced that it's still the best thing for everybody, the insurer as well as the insured, to make long-term deals, because that gives stability in the market and it avoids you to do a useless exercise over and over again every year. So yes, I hope they will stay. But again, I have to speak with two words. COVID-19, I didn't get any messages from my insurers that they would stop doing or making such deals. I renewed last year one for 3 years. So again, here the only thing that I know is the impact of COVID-19 on the whole market and on the how insurers will behave. But separate from that, I'm sure they were going to stay, certainly in Europe. But with this, what happened over the last few months, I don't know what the future will be. But again, I think it would also be good for insurers to have some stability. If they have long-term clients, well, they know how the clients work, what they do, what they don't do, and I'm quite confident that we will be able to keep those long-term deals.
Great. We've got another question here that's come through for Julie. So Julie, how do you measure the impact of demonstrating the VP to your members, and can you point to examples where your members have accepted rate increases? So I guess talking more generally about rate increases and how that can be difficult as a captive or an RRG, running an RRG.
Sure. The way that we've measured the impact of demonstrating the value proposition is generally just from feedback and tracking the feedback, as well as tracking the use of the tools that we provided through the website metrics and the different metrics you can get from the use of our various platforms. So we're able to measure that engagement. And in addition to that, we monitor, obviously, everything that comes into our hotline as well. when you ask about examples where our members have accepted, and I apologize, I can't see the rest. Okay, there we go. The rate increase, it's simply that we had very strong retention after the rate increase, and we had actually 30% growth. So I think obviously that has something to do with the market and how much it's hardened in our particular space of the long-term care field in the United States.
Great. I've got another question that's come through now for Nigel, but I think Julie can obviously comment as well after. So, question to Nigel: group captives are common in the US. Do you see the hardening market perhaps stimulating the group captive structures in Europe?
It's a very posing question. I would like to think so. The issues we tended to have in Europe tend to be real collegiality and having a common pot of funds to finance projects. I've been involved in years ago with electricity transmission providers, service providers, and that turned out not to go somewhere due to a lot of cannibalization in the marketplace, particularly in the UK in that one. We see at the moment maybe opportunities, for example, in the waste business around Europe and even wider, where there is a lack of property damage coverage available in the marketplace. You would have thought industries like that, maybe there is an appetite to consider this. But again, it's through common membership industry forums. Can you facilitate this to get off the ground? They tend to have a long gestation period before they come to pass. In the US, you have an industry of specialists working in this group initiatives, and it's been very successful and obviously fueled by high costs, predominantly in the casualty market space more than anywhere. And some great examples, as we are well aware, with XL and ACE in Bermuda, responding to a casualty market crisis many years ago.
Lauren,
we've got another. Yes, go. Sorry,
I was just
apologies,
going to
Julie.
say it would just depend. Obviously, I think adding the COVID aspect of it, it would depend on if there was any sort of pain that one particular group was feeling, and perhaps they were able to come up with this as a resolution, that this was offered on the menu of resolutions for that.
And so we've got the next question. Do you think the rate increase will be temporary or linked to actual short-term results, but the underwriting restrictions will last? So, Julie, do you want to comment?
I think that rigorous underwriting is very important, and it's very important in all industries. The rate increase will not likely be temporary in the near term, because we're obviously seeing that some reinsurers are pressuring for more rate as a result of the pandemic. So that is a to be determined.
And Carl, do you have any? Nigel, do you have any comment on this?
Well, I think again that the pandemic is the big thing, the big game changer, I would say. I would agree with Laurent that it is a temporary. 3 months ago, I would have agreed with him that it's a temporary correction. The underwriting restrictions that could last, I think, until the results are better again of the insurers. One thing we haven't touched on the insurers is their expense ratios, which are still pretty high, between 27 and 32%. I don't think that most of our companies have such a big expense ratio on top of their actual business, but anyhow, so that's something where some betterments can be done. But yes, I think if the results are not getting better of the insurers, then the underwriting restrictions, of course, will last. The thing is, will they have those restrictions on a global basis, or will they shift them to local or businesses? Because sometimes you can see that some insurers have restrictions that they said, well, it's global for all types of business, and then in other cases they limit it to a certain type of business, or even to particular clients, where they say, well, your results are not good, so thank you. But sometimes, as I said, it's for the complete business type, like waste handling is which is having quite difficult times to get property and BI coverages. So those, I think, as long as the results will not be better, will remain, and the duration of the increase, as I said, it's difficult to make predictions with this whole COVID-19 circus coming on top of what we already had.
And we might I'd only echo what Carl's saying.
Yeah, I think we've kind of run out of time for questions now. So we're going to have to sum up to finish up. But I want to thank the panel. That was a really interesting discussion. And you know, we were going to kind of have a quick break now. So we'll bring Udo back and prepare for our next panel, which is going to be on managing your captive in a hardening market. So Udo, do you have any thoughts on the first panel?
Well, I think there were a lot of interesting findings and statements. First of all, I think we all can agree on the reasons for the hardening market situation, which have been addressed here. Mainly the bad results of the insurers, but as well the low interest rate environment. I think it is important, and this is what I took as well from the discussion, that risk management and mitigation will become even more important for the upcoming months and years. One very important topic which I took from the discussion was the issue with the technical pricing of a captive. So a stable pricing of a captive is really important, and here I see really as well the opportunity of a captive in the future. So if it comes to a situation that an insurer requests an increase which goes beyond the technical pricing of the captive, I think here the captive, depending on its financial situation, can really be added value to a group by increasing its share without changing its own rate. So I think that was quite interesting. And then, of course, yeah, the COVID situation will change a lot. That's pretty sure. We need to see what will be the outcome of that. And I would close my remarks with a very interesting statement as well, which said, from catastrophe comes improvement or innovation. And I think that is as well a huge opportunity for captives.
Yeah, yes, I agree. I think there is a lot of opportunities at the moment, given the current situation. And I think now moving on to our second panel of the day, as I said, which is the topic is managing your captive in a hardening market. So our very talented panel consists of our moderator, Gunther Droes, who is the Managing Director of Ekiroa. We've got Courtney Claflin, Executive Director of the Captives Program at the University of California. We've got Paul Verman, who's the Head of Captive Services at Zurich. And we've got Adrian Colivray, who is Director of International Captive Advisory at Willis Towers Watson. So I will hand over to you, Gunther, to head up the panel.
Thank you very much. This is Gunther speaking, and it will be a pleasure for us to listen to the three colleagues, Courtney, Paul, and Adrian. You see their function and role on the screen. A short introduction of mine. I have been one of the founders of Ekiroa and was for some years the predecessor of Udo. In the function, I had to discuss and negotiate with a lot of regulatory bodies to try as much as possible to find some solutions for captives which are, from a regulatory perspective, acceptable. We still are working to improve the situation anyway. Coming to this title, Managing Your Captive in a Hardening Market, I would like to start with a question to Courtney and Adrian. How do you prepare your captive to support the parent company in a hardening market?
Adrian, do you want to go first or do you want me?
Yeah, sure. I'll go first and then pass it over to you. I mean, Courtney, you've been going through this in reality, so be very interested in hearing your comments on this. Certainly from the perspective of the consulting side, really preparation for me comes into two core pillars. The first one being governance, and the second one being financial preparation. From a governance perspective, clearly as we get into situations whereby we may see reactions from the market in terms of pricing, ensuring that we understand how the market's likely to react as soon as possible, and having the ability to maneuver that within the organization, be it at parent level, be it at captive level, to ensure that we can bring risks into the captive as and when and where they can be, is essential. Now that comes into a number of different areas, and clearly there are some timelines which will need to be considered as part of that. There will need to be consideration for the underwriting process at the very least, and certainly there may in certain situations be a requirement for changes to the business plan, or certainly approvals from the regulator for the inclusion. So certainly from a governance perspective, that's one area. The next one is financial preparations, and that's key. Obviously, a captive, whilst a very useful vehicle, is not an endless pot of money. And so therefore, having the ability to assume liabilities comes to some extent as a cost. And for companies that have had the opportunity to build significant surplus over the years, they've got a little bit of a buffer to assist in that process. Where maybe that buffer isn't in place, trying to assess the overall risk financing structure to optimize where the captive can actually participate. A captive, as opposed to a balance sheet retention fund or a virtual captive structure, for example, has a number of benefits. One of those obviously being the ability to act as an insurance company and interact with the reinsurance market, one amongst many. Yeah. Sorry,
yeah,
yes.
and perhaps to get a little bit more precise reply, perhaps, on this question, what the captive can do to support their owner company. And Courtney is in a situation to manage a captive, so he may have some very precise replies. Later on, we come to the topics you have mentioned anyway.
Sure.
Courtney.
Yeah, using my name and precise in the same sentence is kind of a reach, but it, I just want to preface my remarks by mentioning a couple of things. Number one, I finance risk. I don't manage risk. The University of California system has 5 med centers, 3 national labs, 10 universities, and we've got 1,500 risk managers running around managing the risk day to day. So that's not my job. Secondly, the second caveat to anything that comes out of my mouth today is this is how I've done it. I'm not here to say this is how everybody should do it, because one of our famous sayings in the captive world is if you've seen one captive, you've seen one captive. So with that being said, I've kind of had a two-part strategy to this. I'm old and I've been in the insurance business for a long time, and I understand hard and soft markets. They used to be pretty predictable back in the day in 3 to 5 year cycles, and now we're seeing 10, 11-year soft markets and 3 to 4 hard market, and then back to 10 plus soft markets. So I came to the University of California 5 years ago today, actually. Today is my 5-year anniversary at the University of California, which I'm happy about. When I got here, we had one captive. It was doing 3 things, and the first thing that I wanted to do, knowing the long-term strategy, is to aggregate the risk financing platform into a captive entity or a captive platform. And to that extent, we now have 5 different captives in our platform. There's a couple in development, a couple more in development. We're currently executing probably 50 plus different risk financing arrangements. But one of the things that I wanted to do when I got here strategically was to aggregate all of this risk financing, because prior to me, the risk financing, meaning the procurement of reinsurance and the housing of funds necessary to pay claims underneath our retentions, was all on the balance sheet of the university or in trusts. And they were going around the captive to purchase reinsurance. They weren't using the captive to purchase reinsurance directly and get the advantages of that. So my first strategic move was to aggregate this spend. And then number one, and once it got aggregated, and that took the first 12 months, is to bring everything off the balance sheet, put it into the captive, use the captive to access the reinsurance market directly, which gave us favorable terms and conditions. It gave us better pricing, and it gave us more capacity. With that, I also, on the side, built our own investment portfolio, because now we had $1.2 billion in assets, and to get yield off of that money, where before we were not getting, or if we got any, we got very, very little interest income on that. We immediately began to quota share throughout our towers of coverage and provided by London and Bermuda, which strengthened the alignment of interest between us and the reinsurers. And then to also expand the captive platform to other areas where we could accumulate underwriting income and corresponding investment income, where today it was residing within an insurance company whom we were just buying insurance from. So that was kind of the building blocks of preparedness of the University of California for times of trouble, which is what we're in today. And my philosophy is that your captive is there when you need it. And right now we need it. And so with that as a foundation, then I kind of, we're in the stage today is okay, now how are you going to prepare? So we started 5 years ago to get the structure in a place to provide financial outcomes that were superior to the way they were done before, and we did that to great success. So now we've built up a war chest, we've built up a large surplus, and now we're sitting here staring the worst renewal that the University of California system has ever seen. So how do I prepare the captive for that? Because my terms and conditions they're gonna go south more than likely. We're gonna have more exclusions on our policies. We're gonna be forced to take higher retentions. Our capacity is gonna be affected. We've had syndicates and reinsurers pull out of our towers of coverage completely. We have at the University of California, for those that don't know us, we have a very large risk profile, because we've got 14,000 physicians, we've got 400,000 undergraduate, graduate students, we've got professors, we've got faculty staff, we've got 60 billion of property, we have 5 nuclear power plants, we got stuff everywhere. So we're a hard risk. So the market is almost hard to us all the time. because it's tough for us. But phase 2 of preparing for a hard market is for me as the executive director of captive programs to make sure that I have the financial wherewithal to support the university with higher retentions, covering gaps in insurance, increasing quota share participation, or providing layers of coverage or buffers of coverage, to have the financial wherewithal to do that. Another piece of me preparing is to prepare my board of directors, to prepare the regulators, to prepare my parent, to open up these communication lines, because as we all know in this business, final terms and conditions and final pricing and final retentions come down at the 11th hour, 59th minute. And, you know, I have to be prepared to go to my board and my boss with a last minute change of direction at the 11th hour, 59th minute. So I need to be flexible, and I need to do my modeling up front to find out how much more capacity I can take, which is approved by the regulators, and how much money I have in my pocket to support the university in these hard times. So that's just kind of a brief snapshot of, if somebody asked me how you prepared, I first prepared the financial backstop by aggregating and designing and growing surplus. And secondly, I have to prepare via modeling and communication what I can do to help the university for rate increases, capacity, terms and conditions, so that when I'm needed, I'm prepared, I'm available, and I have the resources to do so.
Thank you, Courtney. We understand, we learn from you that this is a permanent development and that you have to react on the change of the environment permanently, more or less. And may I lead over to Paul with a question. How would you advise someone carrying out feasibility and building off the capacity of captive?
Many thanks, Günther, for that opportunity to respond. Looking at the hardening market environment where we are currently faced with, I have observed some emerging patterns in the buying behavior of our captive customers. So, for instance, captive customers explore whether they can increase their captive share on a gross and on a net basis. And we have experienced that our captive customers currently cede across their international programs around 80% of 100% of their entire written gross premiums to their captive. This is usually implemented by keeping the exposure often on net, of course protected by line of business stop loss protections, or by purchasing comprehensive cross-class protections. Both of these strategies allow them, of course, to approach reinsurance market in an active manner to pursue arbitrage strategies. Furthermore, a hardening market environment usually causes an increase in premiums, as we have already heard earlier today, shortness of traditional capacity, an increase of existing exclusions, and the introduction of newly developed exclusions. In such an environment, captive customers analyze their traditional line of businesses in order to explore whether additional involvement of the captive may be sensible. Especially in Europe, under Solvency II, large captive customers increasingly cede their EB life portfolio to their captives, whereas benefits have been achieved so far by following such a strategy, including underwriting profits, additional risk management insights, optimization of local coverages, and of course, the diversification of the entire captive portfolio under Solvency II. Another possibility to make additional use of a captive is a development of fronting solutions in order to strengthen the core business of the captive's parent. Very often, car manufacturers follow such a strategy across the globe by issuing extended warranty policies, which are then reinsured to the captives. Zurich provides so-called captive health checks in this market environment, whereby complex underwriting and actuarial analysis is used in order to explore how much new and additional exposure on gross and on net may be appropriate to a customer from an economical point of view, considering, of course, the Solvency II requirements and the financial stability. In a hardening market environment, I personally, this is my personal view, anticipate also an increasing interest by the so-called large middle market corporates to use alternative risk financing instruments. A key word here might be virtual captive solutions, and in particular protected cell captives, which increasingly become popular across Europe. This is my personal observation. I'm highly interested, of course, to learn from Courtney how he views the captives risk financing in a hardening market environment, for instance, in using reinsurance markets more. He just mentioned this already, and diversify the captive. I'm not so much familiar with the US regulation compared to the Solvency II regulation.
Well, thanks, Paul. You know, the beauty of an insurance company is that, as I explained it to my boss when I first started, I said, let's go into Nordstrom's and go shopping. And when we go into Nordstrom's to go, which is a clothier here in the United States, you get to see all this stuff on the shelves, and you get to buy anything you want to see. And I said, I get to walk, as an insurance company, I get to walk to the back of the store, use a special card, and get into a special room where you can't buy stuff, but I can, because I'm an insurance company. Well, the reinsurance market is the same way. There's more capacity. There's players that will, there's reinsurers and syndicates that will only talk to insurance companies. And so, by virtue of that, and now in this kind of a market, I can use my insurance company status to try to go find risk financing solutions that are not available to the general public, because they're not insurance companies. And so when it comes to capacity, you know, I've got reinsurance capacity through the reinsurance marketplace, and our marketplace is London and Bermuda. The domestics don't like us. Or I shouldn't say they don't like us, but we're too complex for the domestic marketplaces. So we buy all of our reinsurance in London and Bermuda. Well, my insurance company status also lets me, gives me access into alternative marketplaces, such as insurance-linked securities, cat bonds, etc. And so when you come down to a time like this, as an insurance company platform, I have to explore on behalf of my board and my boss, what other alternative financing arrangements out there are available to me, in addition to just towering up a tower of coverage with 10, 12, 13 different reinsurance companies. So the flexibility behind that gives me the best opportunity. Doesn't mean that I always succeed, but it gives me the best opportunity. The second thing that I can do, which I need to model for and to find out what my capacity is as an insurance platform, is where am I going to plug the gaps where I don't have reinsurance support. And because at the end of the day, I have the money and I have to pay the claim. And I may be paying claims where it's commercially unavailable, but I got to pay them because it's the University of California. We incurred these expenses. I have the money. So I designed my policies with differences in conditions on all my 50 plus contracts to allow me the flexibility to pay something that otherwise is not covered or supported by reinsurance. So all of that goes into the preparation of how much money do I have available to me to give back in support to the university and its constituents.
May we lead over from this remark to the question of the overall risk financing strategies? Perhaps Adrian, you may comment on that.
Yes,
on my role?
thank you. Good. Oh,
Or you're talking to Paul? Okay, excuse me, or Adrian. Sorry.
sorry, this is Adrian.
Yes, Adrian.
No, I mean, look, I think from the overall risk financing strategy, obviously the captive is a core part of what's available and what can be used within to assist the organisation. I suppose the question is how much risk needs to be retained in order to use Courtney's special backroom pass. And obviously there will need to be some, but there will be organizations that won't necessarily have the surplus or the funds to be able to insure all the risks that they want to. So from an overall risk financing strategy perspective, there will be a need to have a look at alternative strategies, such as, we've mentioned the virtual captive a couple of times. There are other options as well in order to provide other options for the risks that maybe don't end up sitting within the regulated captive vehicle. It's also worth mentioning that within that overall risk financing strategy, we have a habit and have had a habit for a number of years of focusing on silos of risk. Those silos of risk, but looking at the property, looking at the casualty, looking at each of those, and then we create capacity within each of those silos, which end up stacking on top of each other. Well, at Willis Towers Watson, we actually look at how those risks correlate, or more importantly, don't correlate with each other, so that we can understand actually what of that capacity is somewhat redundant when we look at different levels of confidence, so that we can reapportion or be more realistic in terms of the expectation for the amount of capital that's required in order to meet those needs, and therefore have more capability for ensuring what needs to be insured within the captive.
Paul,
may I add? May I add to this comment, Günther, please, from a European point of view?
And also using the reinsurance to achieve more capacity, better terms and conditions. I think this is an opportunity for the captive and the captive owner in the market for in his financing strategy. And I fully agree with Courtney that insurance for corporates and institutions is not purchasing a commodity. It is just and only how to finance future losses and claims. So it is a finance issue. It is not commodity. Very often in the market, it will be seen as something which has to be cheap and simple, but this is not usually possible. So, Paul, how would you comment on that?
Thank you very much. Just from a European point of view, captives which are regulated within Europe under Solvency II, where we all know this is a risk-based approach. This means that such captives have to back the underlying market risks and the underwriting risks with equity. And captives with a high solvency capital ratio could be able to underwrite, of course, more risks on it in a hardening market environment, while continue to maintain a sufficient solvency capital ratio as requested, of course, by the regulator. And in this regard, we have experience from a Zurich point of view that the highest benefit of diversification for captives under Solvency II can be achieved by bringing together non-life and life exposure. On the other hand, looking to the market crisis and to the investments of captives, it might be possible that in existing investments like corporate bonds get downgraded within the balance sheet of the captive, and which would then require the captive to hold more underlying capital, of course. In this regard, it's important for a captive owner to rely on a very good asset liability management. This is just an add to the other comments, please.
So what do you expect how you can ensure the long-term growth and the expansion of your captive? I understand that the University of California is covering as much potential risk as possible, so a lot of various lines of insurance. What do you expect, also Adrian, from the market to make sure that the captives, and we have more than 6,000 captives in this world, will grow by what kind of, or which kind of, let me say, additional business, or growing by size and higher self-insured retentions? What do you expect? Adrian, perhaps.
Well, Is that
Sorry,
to
Courtney,
me
go
or
ahead.
Adrian?
Yep. No, go, Courtney.
Oh,
Yeah.
well, I grew up in North Dakota, so I always plan for the worst and hope for the best. And I think from my perspective, I need to understand how much capacity I have, financial capacity, to support what's going to come down the pike from the reinsurers as it pertains to retentions, pricing, and limit. And one of the nicest things that we have is we have a very robust modeling platform, because we take retentions based in large part on what the market's telling us we have to take. And that's kind of been the MO all along is we're at $5 million retentions and we're going to hold on to those as long as we can on these lines of business. But over here, we're 10 million, over here, we're 7.5, et cetera. But a robust modeling system that you can integrate into your operations can say, well, that may not necessarily make sense. And the modeling system can do millions of iterations and says, you know what, on your EPL, why don't you take the first 25 million? And on your medical professional, your medical malpractice, why don't you take 5? And on your property, why don't you take 25? And it helps you from the perspective of, we've always done it this way, but is that the right way to do it? Well, when you have proper modeling and analytics behind you, you can start to make more macroeconomic decisions on your portfolio that can at times defy conventional wisdom based on your history, based on the marketplace, et cetera. The other thing that we do quite a bit of is we're very diverse, and everybody understands the core coverages that a company has with property, liability, workers' compensation, cyber, medical professional, all of that stuff. Those are traditional, but you can use your captive to go grow your income, grow your asset base by diversifying your captive. And for example, employer paid and employee paid life insurance. We paid $60 million a year to an insurance company for life insurance. And we did a feasibility study on it and said, hey, there's $10 to $15 million a year of profit there. And so we entered into a reinsurance agreement with the life insurance company where now we retain the profit and the corresponding investment income as opposed to the insurance company. Now, if you do that on 10 or 15 different lines of coverage, on programs that aren't traditional, work comp, GL, auto, you've created a diversified portfolio where it's the truest sense of the word insurance, where some years this piece over here is really going to be in bad shape, but it's going to be offset by this high-performing piece over here. Well, what we've built here to the best of our ability and continue to do so, because we've got at least a half a dozen major projects in development, is we've strived to balance our portfolio so that regardless of what hard times in which particular line of coverage or which particular type of coverage, that we've got ballast on the other side because of our diversity, and our diversity provides us that ballast. So while I'm being very successful over here, this side of the equation may not be so successful, but they counterbalance themselves and keep an overall financially stable portfolio that's pretty steady year in and year out. We're growing surplus, and it positions us in times like today where everybody's running saying, how are we going to do this? What do we do? These are expenses we didn't expect, and so on and so forth. And we say, it's okay. It's okay. We got you. And so I think combining knowing the appropriate structure from retentions, limits, et cetera, and having the diversity base underneath that, I think what I've tried to do and what we try to do is inoculate ourselves as much as possible against what is happening right now.
Yeah, this very much explains that there should be a flight into diversification for each and every captive. Well known that a huge number of captives, especially in Europe, they are focused more or less on 2 or 3 lines of business, and that's it. So your approach in California, I guess, is one of the main targets everybody should bear in mind when he is considering how to discuss internally with his CFO, CEO, whomsoever, chief risk officers, how he can expand his activities.
Yeah, I might just, sorry, Gunther, this is Adrian. I might just say, you know, you've referenced a couple of people there, but certainly understanding the scope of the stakeholders who are involved in the captive. I think historically we only had sort of treasury, finance, maybe the risk and insurance managers, but today the scope of the stakeholders involved in captives is much wider, and ensuring the future of the captive and trying to get that diversity is key to have as many key stakeholders within the organization as possible that are going to have an input into this strategy. That includes tax, that includes insurance, that includes the risk management functions, not just the insurance functions, the human resource functions, etc., all working together to bring the captive forwards in the most efficient way around a strong governance and prudent underwriting strategy.
I fully agree with you. Are there any additional comments, Paul, perhaps?
Yes, from a long-term perspective of the use of captives, I'm very much convinced that captive owners view their captive as a strategic door opener to the reinsurance and alternative markets. Globally operating insurance networks could be viewed by captive owners in future more in the direction as a service provider, and perhaps major shares of the traditional risk transfer could potentially be shifted behind the captives. This is a strategic view and an observation which I have from my end.
Great. Well, that was a really great discussion, everyone. So I think I might come in now and start with the questions from the audience, because we've had a couple of questions come in from everyone listening, which is really fantastic. So I'll start with the first question we have here, and I'll direct this one to Courtney as a captive owner. To start off with, so do you expect an increase in the number of captives in Europe and the USA in the next 3 years? So what's your perspective as a captive owner?
I would say absolutely. Captives originally were invented, quote unquote, by a group of textile manufacturers in New England that could not purchase fire insurance. And that grew into what is now known as FM Global or FM affiliated. And so captives are, they can be a mechanism, a risk financing mechanism of first resort or last resort. And captives invent things. The commercial marketplace doesn't invent a lot. A lot of innovation comes out of captives, and it comes out of captives because the marketplace has told us we're only going to do this. And so as a captive owner, I have to respond because my parent is going to be looking to me to support them. And almost to the point where we don't care if you have protection or not, you've got all the money. And so I think the ability of captives to be nimble, to be formed rather quickly and efficiently, is going to grow because the marketplace is going to respond, and the marketplace is going to constrict. The marketplace is going to price people out of the game, and captives will be there to respond either with new formations or with new lines of coverage. So I absolutely expect the captive marketplace, and we're seeing indications of that from a regulatory standpoint all across the U.S., that it's going to increase.
Laura, may I add something to the comments of Courtney, please?
Of course.
Paul speaking. Yeah, thank you very much. From a European point of view, where we have a lot of so-called large middle market corporates, where they have a lot of subsidiaries across the globe, I have experienced that a lot of those companies are currently exploring captive, and in particular, as I already mentioned, virtual captive solutions. And I anticipate for this segment, the top middle market in Europe, an interest, a growing interest in exploring virtual captive solution, and probably use protected cell captives, where we have in Europe 1 or 2 locations to set up such solutions, because they are highly interested as well to get the same flexibility like captive owners. Thank you.
And Adrian, what are your thoughts on this?
Concur with the panel. Quite frankly, we're seeing a huge amount of interest, quite frankly, in captive utilization. I think the key challenge is not going to be about companies' desire to have or want captives. It's going to be down to liquidity, primarily resulting from COVID-19. Companies having the access to cash to be able to participate will probably be the key challenge. But that aside, there's absolutely a desire from large M&Es, multinational enterprises, down to sort of higher middle market. And obviously we define higher middle market slightly differently to the US, which obviously has an active involvement in captives already.
Do you have anything you want to add, Gunther, on this?
Can't add very much, because I always say, if we, the captive, let me say, experts, would get the chance to talk with CFOs and CEOs more about the business rationale of a captive, you may need, with all the positive arguments, maybe 30 minutes to 1 hour, and then you may convince these people, which today have a lot of fears that they may start with something which costs a lot of money. They see there might be some regulatory, let me say, problems and additional workload, documentation, and so the fears in the on the C level is bigger than necessary, and I guess that the advisory side is not very much developed in these industries. So I know that Adrian is doing something like that, but also he and all his colleagues, they need to get this access to the decision makers in the big companies. But then it will jump up, I think, especially in Europe, because we are, I guess, we are really underdeveloped so far.
And so the next question to start off, I'll direct to Adrian to start with. Would captive managers see this as an opportunity to take additional risks otherwise uninsurable, such as COVID-19 or pandemic BI, as net risks?
Yeah, I suppose the first caveat before we start, uninsurable from the perspective of unable to get the insurance in the market, rather than it not being an insurable risk. As an insurance company, obviously it needs to be insurable. However, yes, absolutely. And we're already seeing a huge amount of discussion and questions. Clearly, COVID-19 is likely, or probably more than likely, be excluded from policies moving forwards. Pandemic risks from a wider perspective, we're seeing a lot of interest. The key concern around it all is, how do we model it? We heard from Courtney earlier how he has a strong modeling methodology. It's very difficult to model this risk. I'm only aware of one reinsurer at the moment that has real capabilities around this area, and clearly they will be very busy moving forward. So being able to model it, being able to understand what liability you're actually assuming within your captive, and managing that within the risk appetite of the organisation, it is going to be key, but no doubt there will be a significant increase in the desire to include these in captives moving forwards.
Well, look, I think we've kind of run out of time to answer any more questions, unfortunately, because the panel was so great at talking earlier with Gunther's fantastic questions. So I do want to thank everyone so much for taking part, and invite Udo back to say some quick words as a bit of a conclusion. So Udo?
Yeah, hi. Well, it's really difficult to summarize the last discussion, and I would say I would conclude by saying that how to manage best a captive in a hard market environment. I would take up two statements. One is it's not only managing the captive itself, it's as well managing various stakeholders around the captive, like regulators, the own management of the owning company. This is one thing, and the other the other statement I would put on the table at the end is that of course there are always limitations in a hardening market phase, depending on how much surplus you have built in your captive. You can extend that a little bit by protecting your captive with certain alternative risk transfer, but at the end of the day, it's an individual situation of each company and the captive, and everyone needs to see what's the best possibility to support the company. One important element, of course, is as well to diversify as much as possible, especially for the European captives, in order to get a better level of underwriting capability under the Solvency II regulation.
Great, thank you so much. Well, I just want to thank you all for tuning in, and just a reminder that next Tuesday we have our next virtual symposium, so I hope you can all come back for that, and have a great day.
And you. Thank you.